Change of category of company. Accounting section of CFO 100. The transaction making a change in categorization for the group company is a big event from an accounting point of view because it contains complicated accounting matters. In this lecture, you can understand what type of accounting impact happens in each scenario with the change of category of the group company. If you have many group companies or you are trying to invest in a new company, this topic is a frequent point to be discussed, and CFO needs to clearly explain the impact of the transaction to the management. For that purpose, what you need to do first is an explanation of several basic concepts which are related to the change of category of the company. It contains several technical points of view which are not familiar with non-accounting persons. The below list has 4 items. The first one is the full line consolidation. The second one is fair value recognition. The third one is OCI and retained earnings. The last one is PPA, purchase price allocation. You have an accounting or finance background, so you easily understand what is it. But for non-accounting persons, those 4 concepts are very minor and difficult to understand. So, before going into the detailed explanation of the change of category of company, you need to introduce those 4 concepts to the people who want to understand what happens in the transaction. As you simply go through top to bottom, you should see whether it has an impact on P&L. This is the most interesting point for the management. Full line consolidation means the combining P&L and the balance sheet of parent company and subsidiary as one entity to make the consolidated accounts. That transaction and treatment, it doesn't have any impact on P&L. On the other hand, the second point, fair value recognition, sometimes causes an impact on P&L. This is the concept that you need to evaluate the value of the asset based on fair value. The third one is the transition of balance sheet items into a different one. It doesn't contain the P&L impact. The last one is PPA, which means that an excess amount of investment larger than the net asset value will be recognized as an intangible assets, and it doesn't mean the impact on P&L. As the preparation of an understanding and explanation of transition of the category, it is good for you to utilize these set of explanation. On the next page, you can see the case study of transactions. Once you record the basic 4 concepts related to the change of the category of group companies, you have prepared a basis for discussion. In the left side picture, you can see the transaction which changes the categorization among subsidiary and affiliate themselves. There are 4 types of transaction between the companies. So the right side of the table shows what happens from an accounting perspective in each transaction. The first one is the changing the category from an affiliate to a subsidiary. It happens when the parent company increases the share percentage and gets the control of this company. In such a case, you need to do full line consolidation and the recognition of fair value for the existing amount. It causes an impact on P&L. The second one is the opposite side of the transaction, that the subsidiary becomes an affiliate with losing control. The capital gain generated by that transaction will be recognized as P&L for the parent company. And also the remained amount will be recognized based on the fair value, and it also generated a P&L impact. If you look at the transition between affiliate and affiliate, it can happen in the case that you buy the additional share of the affiliate. In a share-up case, PPA for a newly acquired part will be down, but there is no fair value recognition for the existing amount because it has already been recognized when the first acquisition. In the fourth transaction, it is a situation that you divest some portion of the share of the affiliate. The capital gain causes a P&L impact, and there is no fair value recognition of the existing amount. When you understand those four transactions, the important thing is that you need to keep attention to the P&L impact of each transaction. Generally speaking, share up and down is a capital transaction, so you forget the effect on P&L. However, as a CFO, you need to explain it to the management what kind of impact the targeted transaction has. You should take note that this picture and explanation are based on the assumption that there are actual share sales and purchase. But the change of category of the company occurs in the occasion of share up and down, not by your company, but by the JV partners. In this case, control and significant influence may be changed, and you need to consider the change of categorization. Even in such a case, the way of thinking and the basis of accounting treatment is the same as that in this slide. In the previous slide, you understand the transaction between a subsidiary and an affiliate, and affiliate and affiliate. On this page, there is the treatment for FVTOCI. The transaction between FVTOCI and the subsidiary or affiliate has different issues from the transaction in the previous page. If you look at the right side box, you can see the description of each transaction. From number 5 to number 8, the first one is becoming from FVTOCI to a subsidiary. It requires full line consolidation, and the OCI turns into retained earnings. When a share is down and it becomes FVTOCI from subsidiary as the opposite direction, the capital gain generates P&L impact, and the recognition of remained amount causes P&L. The change from FVTOCI to affiliate doesn't have any P&L impact, though PPA for the entire investment amount should be done, and OCI turns into retained earnings. And lastly, in the transition to FVTOCI from affiliate, the capital gain generates P&L impact, and the fair value recognition of remained amount also makes P&L. Overall, on this page, you can see two transactions that have an impact on P&L. You can take note that FVTOCI includes not only financial instruments but also non-consolidated subsidiaries and affiliates. So, in case of that, the company decides its direction of liquidation subsidiaries or affiliates. Those companies will become out of consolidation. It means that this type of transaction happens without any current share up and down. You keep those 8 points in your mind. However, the transaction for change of category is the most complicated accounting field. This lecture doesn't touch on tax and TA points of view. Those points also should be considered when you analyze the impact of each transaction. Otherwise, it has an unexpected gain or loss on your books of accounts. As a CFO, you need to make an accounting manager review the correctness of the treatment carefully. In another lecture, you can see those details points and the ledger of each transaction as well. Actual entry and ledger can enhance your understanding and entire coverage of this topic.